Good afternoon, everybody, and welcome to the latest in our series of professional advisors working lunches, today brought to you courtesy of our partner, Baillie Gifford. I'm Hope Williams-Smith, editor of Professional Advisor, and I'll be your host for the next hour. Before we get going with today's session, let me quickly run you through the usual housekeeping. Your microphones and cameras are currently switched off, and we'd be most grateful if you could keep them that way. It will just ensure there's no background noise so the speakers can be heard nice and clearly. I should also inform you that this session is being recorded and we will send you a link of the recording by tomorrow. Do feel free to share this with your colleagues. As usual, today's working lunch will qualify for 1 hour of CPD and we'll be sending your proof of attendance along with a link to the recording of the session, which should arrive in your inboxes tomorrow. Today, I'm delighted to be joined by Baillie Gifford's John Henry, who is a Client Service Director with the business. Over the next hour, John will be talking about the Monks Investment Trust, Baillie Gifford's views on the long-term future for the trust, and also the philosophy behind it. Do feel free to put any and all of your questions to John using the chat function, which you will find at the bottom right-hand corner of your screen. If you wish to remain anonymous when asking you a question, then simply select my name from the drop-down list in the chat box first before you type your message, and only I will be able to see it. Now, just before I hand over to John, let me quickly run you through our learning objectives for today. So by the end of this session, you will understand the philosophy that sits at the heart of Monks, understand the importance of structural changes in society and technology to the delivery of long-term returns, and understand why Monk's approach leaves room for optimism for patient long-term investors. So that's the CPD covered. Let's hear from Baillie Gifford's John. Good afternoon, John.
Hi, Hope, and thank you very much for that introduction, and good afternoon to everybody. Thank you very much indeed for dialing into this call. So as Hope mentioned, I'm going to cover the Monks Investment Trust just over this next hour or so. Now, before sharing some slides that I've got, I thought it'd be worth just setting out, what are the key elements of the trust before launching into some of the finer details. I think firstly is that Monks is very much a global all-equity investment trust. We focus especially on companies that can deliver earnings growth over the long term, and therefore the trust is all about capital growth rather than income. So we pay the absolute minimum by way of dividend to maintain our investment trust status. So we see Monks as very much the best collection of growth companies anywhere in the world, and that's really what we're seeking to do, is create very much a best ideas portfolio. Now, what I'll do is I'll just start by sharing some slides. Hopefully you can see these slides okay. Now, I think the best place to start with regards to Monks is the team that looks after the portfolio. Monks is looked after by the Global Alpha team at Baillie Gifford, who've been running this approach for 17 years, and is headed up by Spencer Adair, who's the lead manager in Monks, and Malcolm McCall, who's the joint senior partner of Baillie Gifford. So between them, they have upwards of 50 years experience in investing globally, and they're supported by a dedicated team at Baillie Gifford of 4. In Monks's case, we have Helen Zhong, who is also a partner of Baillie Gifford, and 3 analysts, one of which is a dedicated ESG, environmentally sustainable and governance analyst. So really well-resourced and experienced team that's behind Monks. Now, I think the important point to emphasize here with regards to Baillie Gifford is that Monks is very much at the heart of the firm. So we have what we call a scout network, and not of the Baden-Powell type, but simply regional representatives within equity teams right across the investment floor at Baillie Gifford, who put forward or bring forward their best ideas from their respective regions. So you can see on the slide there, we have dedicated analysts from Europe, UK, China, and North America, among others. And it's really their role to put forward what they believe to be the best ideas from their areas, but also, and importantly, challenging us on the existing portfolios. There's an important dialogue that takes place as part of the investment process there, but we really do harness the very best ideas from right across the investment floor at Baillie Gifford. So what is the philosophy of Monks? Well, I think there's three really central tenets to the way we manage the portfolio. The first is it is all about sustainable and superior long-term earnings growth. Now, by that, we mean above market average rates of growth for earnings, because that is what we believe drives share prices on a 5 to 10 year view. That relationship can break down over short periods. So for example, we've seen that over the course of this year where companies are continuing to deliver quite strong levels of earnings growth, but share prices don't reflect that. But on very long-term view, there's a lot of evidence that suggests if you can identify companies that can drive and grow their earnings at the very top end of the market, that it's those businesses that can deliver share price appreciation. And it's those types of returns that we're trying to capture within Monks and for shareholders of Monks. The second point is that we acknowledge that it's really the few that drive wealth creation within equity markets globally. So we've partnered with an academic called Hank Bessenbinder from Arizona State University, who's really helped clarify our thinking around this. But in essence, what his work has shown is that something like 1% of global listed equities have driven pretty much all of the value creation over the last 30 years. And actually a vast majority, 99% of those businesses have cancelled each other out. And really, what does that mean? Well, that really just means that it's the few that matter. It's really the few on a very long-term view that drive returns for investors. So we've structured a portfolio in managing Monks that seeks to capture, at least as we see it, some of the very best growth companies available to us. And the third and final point is simply we must be long-term stewards of capital. So, we acknowledge that not all the companies we own are perfect. But what we must do as responsible and long-term investors is we must engage with those businesses and we must help those businesses grow, and we must be sensible stewards of capital in a very long-term view. And that's really critical to delivering better outcomes for investors. So in terms of the growth, I've talked about the fact that we seek earnings growth, but I think an important part of that is that we recognize that growth is delivered really in lots of different ways. And we split the portfolio into three different types of growth. We have growth stalwart businesses on the left of the slide. We have rapid growth companies in the middle, and we have cyclical growth companies on the right-hand side. Now, I'll touch on these each briefly. The first on the left is the growth stalwarts. Now, these are businesses, as the name would suggest, that are very durable, that are established, that often have large customer bases, that they're able to gradually increase prices and grow their earnings in a very steady way. So these are companies that actually, through different economic environments, should perform pretty well. The example we've used there is Analog Devices, which is an analog semiconductor manufacturer. And it's a really strong franchise. In a global sense, it's really only themselves and one other competitor that serve the global market. So we really feel that's competitively a very well-positioned business. Now in the middle, we have rapid growth companies, and rapid growth businesses are very different to stalwarts. So these are companies that are much earlier stage. They're often very innovative, and they're either disrupting an existing industry or perhaps even just creating a new one in its entirety. And what you often see with these companies is a significant level of revenue growth, but you need to be patient for earnings and profits to be delivered a number of years down the line. So the example we've used here is Adyen, which is a Dutch-listed payments business. And Adyen is completely changing the way that payment technology works, and is allowing and facilitating global payments to happen much more easily and much more cheaply for a wider range of users in terms of merchants and businesses. And finally, cyclical growth businesses is on the right-hand side. And And we recognise here that earnings growth is not linear, and indeed it may go through cycles. But the important point is that the peak of the next cycle is higher than the prior. And these types of companies often have and must have strong capital allocation capabilities. So being able to deploy capital at the right time, so that when the cycle turns and things improve and demand improves, the business really stands to benefit, having invested at the right time rather than at the peak. And the example we've used here is Martin Marietta Materials, which is a building aggregate supply business in the United States of America. And Martin Marietta dominates its core markets, dominates its local markets, and really that facilitates a strong degree of pricing power, because in short, the CEO told us that they make little rocks out of big rocks, which is a nice way of simplifying the business, but you don't want to move those sorts of materials very far. So they dominate their local market. They're able to price in a very generous way, and the margins that they generate off that are very attractive, and they've been able to grow their margins consistently over time. And all of that comes together. So we have there are 3 different flavors of growth, but actually the baseline is that growth must be delivered at the basic hurdle of doubling in share price terms over 5 years. That can be met in different ways, but it's important that baseline is held within the portfolio.
Thanks, John, for that interesting opening look at Monks. I just wanted to quickly jump in here and ask, to what extent are you really bottom up? I mean, surely you must consider some macroeconomic factors here.
Yeah, so I mean, that's a good question, Hope. I think we are resolutely bottom up in our approach in terms of managing the portfolio, and a vast majority of our time is spent looking at companies, because ultimately that's where we see our edge. So we feel we can get to know businesses, we can spend time meeting company management teams, analysing competitive advantages, and thinking about what a business may become on a very long-term view, and that's where we see our edge in terms of the portfolio. But I think it's important to emphasise that doesn't mean we don't consider macro factors at all. Clearly, at the moment, there's many big questions that investors have and savers have. So, for example, we've looked at this portfolio with a view to persistently rising levels of inflation and interest rates, and how resilient this portfolio and the companies within it is likely to be on a long-term view. And we've also looked at what happens if the consumer starts to tighten its belt quite significantly over the next 18 months to 2 years. How might that affect the portfolio and the holdings within it? So, we do absolutely consider the broader economic environment and how that may play into our individual investment cases. But what we don't do is forecast where those variables are going to go. So, I really hope everyone listening has lots of questions for me, but if one of the questions is, when will inflation stabilize and fall, or when will interest rates moderate? We don't have a particularly strong answer on that because we don't have any edge in predicting. But what we would say is that the companies in this portfolio and the portfolio in aggregate are pretty well placed to navigate this environment. And we think that on a long-term view, it shouldn't disrupt the earnings potential of the businesses within the portfolio.
That sounds good. Thanks so much, John.
So, I mean, to continue on with the slides and the further introduction to Monks, I think the next area I wanted to move into was, having addressed the philosophy, how does that actually play out in practice, and what is the process behind managing a portfolio that has around 120 holdings? Well, I think the first place to start is, well, how do we go about identifying what we believe to be the winners in global equity markets, where, in truth, we have over 4,000 stocks that we could choose from? The first, I think, is the discovery phase, which is on the left-hand side of slide 8. And I think really the key and differentiating factors of what we do are, firstly, is we rely on absolutely no sell-side research. So we do all of our own proprietary research, and that's a really important point, because in order to have a differentiated view, we must be coming up with our own opinions, doing our own research, and modelling our own growth for each of the individual holdings within the portfolio. We go out and meet company management teams now. Obviously, the pandemic in the last couple of years has curtailed some of that activity, but really pleased that this year we've been able to get back out onto the road. And Helen John, one of the analysts that I alluded to, spent 10 days in South America and met a number of really interesting companies, as well as some of the existing holdings within the portfolio, particularly Mercado Libre, which is an e-commerce and payments business in Brazil, Argentina, and Mexico. And we were really able to get under the skin of that business and gain further assurances about certain aspects of its competitive advantage. So it's a really important point that we're able to engage on the ground with businesses to generate our insight. And then I think that one broader point might be that around our differentiated recruitment. And again, this comes back to, if we're going to identify businesses that have the potential to grow and ultimately deliver superior earnings growth for the portfolio and therefore share price appreciation, we need to be quite diverse about how we think about that. So in recruiting on the investment floor at Baillie Gifford, we actively recruit from a very wide range of backgrounds, not in any way favouring financial backgrounds or accounting backgrounds. We've got investors on our training programme who are degrees in history, who are musicians, who have been in the armed forces, who come from engineering backgrounds. So we really do seek to embrace a very broad range of disciplines that ultimately we think that helps us bring different perspectives to our investment process. Now, the second phase is the debate phase. Now, I've alluded to this already, that Monks is plugged into a really broad set of different regional backgrounds, with individuals bringing forward their best ideas and challenging us. And that's really what this central donut in the slide depicts. So the portfolio review group is in the middle. We hold these meetings every 6 weeks or so, and each of those teams brings their 5 top buy ideas and their 5 top sell ideas. So they're effectively saying, look, actually on the sell side, we ask people to step into our shoes. If you were managing this portfolio, what are the stocks that you would sell and what are the stocks that you would buy? And that's a really important process and debate, and it's a culture that we foster at Baillie Gifford, and we like to do that on multiple occasions, either in slightly larger groups or breaking out, having stock discussions and really tackling individual businesses on a case-by-case basis. And once we've moved through that process and we've taken the research on a stock sufficiently far, the decision makers on Monks will then ask 4 key questions of each holding. One is, how does this business compare globally? Because as I mentioned, Monks is a global portfolio looking to invest in the very best growth businesses anywhere in the world. So we want to own the best version of that business. The second question is it sustainable? And this is a really important question because it's a nod to ESG considerations. They are very broad and varied in nature, but this is intended to capture anything which could prevent that business from sustainably growing its earnings on a very long-term view. The third question is, where do we differ from the market, which is really a recognition of the importance of valuation. So a business may well grow over the next 5 to 10 years, but if everybody in the market recognizes that already and the valuation is very high, that's no good for us as investors, for Monks, and ultimately for the shareholders within the trust. And finally, what does it add to the portfolio? So as I mentioned, we have 120 holdings. So really the important thing that we must get from each new addition is something different. We're looking to embrace that diversity within the portfolio. And actually, that's a really critical point, which we think is fundamentally important to returns. So when I was on the earlier slide showing the growth profiles, the research that we've done on our portfolio over the very long term shows that the performance and the outperformance of the portfolio occurs more often than any of the individual growth profiles on their own. So together, they're able to deliver outperformance more often than each of the growth profiles individually. So I was just going to move on to the portfolio and how that looks. I'll give you some examples of companies within the portfolio, and then importantly address the broad shape of the portfolio and how it's positioned. So we've drawn out 3 different stocks here, one from each of the growth profiles that we've touched on already. The first and the compounder on the left there is Microsoft, a company I'm sure you're all fully aware of and highly likely to be significant users of. Now, I think it's a great example of a compounding business, a company that has effectively become an infrastructure for all of us. The way the business charges its revenues is a subscription model, which it charges to enterprises, and is therefore very steady in nature. And the business has a real growth kicker, which has come from its cloud computing platform, which is called Microsoft Azure. And it's becoming increasingly profitable and becoming a much more important part of the business, and is consistently growing its earnings in the order of 20% per annum, which is exactly the sort of earnings growth that we're looking for within this portfolio. And in fact, I would say Microsoft is slightly above the kind of baseline of earnings growth for compounding businesses, for stalwart businesses. So it really is a well-known but very capable compounding business. The middle company is Adyen. So this is our example of a rapid growth or a disruptor business. And we talked about that a little earlier. It's really becoming that go-to platform for small to medium-sized merchants, particularly in Europe, but increasingly globally. As it's noted there, with expanding its addressable market into places like the US, and it's growing its revenues over 40% year on year. It's still pretty embryonic, but actually, on a long-term view, it could be really attractive as it simplifies the proposition for its users. And then finally, Charles Schwab. Charles Schwab is a leading independent financial advisor business in the US. Now, what's happening there? Really, growth is going to come from two main areas. One is Charles Schwab is pushing and rolling out its advisor network across the US and becoming the leading brand and trusted brand in the US. But also, it's growing the number of services that it delivers to individuals. So you go there for some tax advice, but actually they then are able to give you some investment services and discretionary portfolio management services on the side, and they grow the business with each and every individual customer over time. And a helpful recent kicker for that particular company, of course, is the rising interest rates and the interest margin that company will then be able to earn on cash balances held by customers. So another good example of a cyclical business or a capital allocator within the portfolio. Now this is what the portfolio looks like. So 120 holdings, that's a lot of names. And I think really I'll start by talking about what you're actually looking at here, which is the portfolio split by growth profile that I've mentioned, but also by holding size down the left-hand side. So the holding size is an important discipline in terms of how we manage monks. Really what we're trying to do here is give ourselves the possibility, the option of owning a large number of names, of which we recognize some may work and some may not. But the important thing is that the ones that work really drive the long-term returns of the portfolio. So we have over 40% of the portfolio invested along the top there, and these are our more established, larger positions at around 2% of the portfolio. So in simple terms, these are the companies that we have most conviction that they're likely to meet our doubling your money on a 5-year view. So we think these are the companies that have the highest probability of doubling their share price over the next 5 years. As we move down through the portfolio, we have our mid-sized positions, and we have our smaller positions, around 0.5% of the portfolio. And these are what we call the incubator positions. And as I alluded to just there, these are the companies that we recognize as a high risk reward trade-off, but we need to embrace the asymmetries of equity investing. So we need to recognize that yeah, we can lose 100% of our investment here, which is absolutely not what we're seeking to do. But we recognize the downside is 100%, but the upside is uncapped. And if we think that there's a probability sufficient that one of these businesses or a handful of these businesses that go on to become 10, 20, 30 times their size today, then that's going to drive the returns of the portfolio and outweigh the losses that we make elsewhere. And so by holding a greater number of these opportunities, we think that gives us a better or higher probability of being able to identify and own those businesses over the very long term.
Thanks so much, John. Just another quick question that I wanted to ask here. Do you target weightings across the different growth portfolios? And if so, how do you find that benefits the portfolio?
Thanks, Hope. I think we don't target it explicitly. So we're not saying that we want X% in rapid growth. It's very much the output of our bottom-up process. I think it's helpful in embracing a diversity of growth. So having a mindset which is seeking to build a diversified portfolio by identifying that companies grow in different ways and embracing that, I think it helps us maintain an open mind in identifying opportunities. And I think it's also a good sort of ex-post check on the portfolio. So, as I say, the split between the growth profiles is an output, but we're able then to reflect on that and say, does that reflect where we think we should be? So, for example, at the moment, we have more in growth stalwarts than the other two growth profiles. I think as we look forward, we think it's very likely that we should be deploying capital within the portfolio from the growth stalwart businesses, which have held up very well in share price terms, into opportunities that are perhaps more cyclical in nature, or where the rapid growth companies' share price falls have been so sharp that we don't think that fairly reflects the underlying performance of the business. And I think the important last point to emphasize is one that I just made around the fact that actually by having these growth profiles, and when the analysis that we've done shows that the portfolio really benefits from that diversification. So in aggregate, the portfolio outperforms more often than any of the individual growth profiles on a standalone basis.
That makes a lot of sense. Thanks for clarifying.
So I think that really moves us on to outlook and where we see opportunities moving forward. Now, I'm sure, and I hope there are lots of questions from everybody on this. So I thought I would start by sharing just the high level research agenda that we produce at the start of each year. And the framework here is really one where we take a step back and we say, well, what are the broad areas of change, structural change, that we think could lead to some interesting stock opportunities, and where should we go hunting for the next a new crop of ideas. And what you're seeing on slide 13 there is the 5 different themes from this year. And I'm not going to go through each of them individually, but I do think it's worth touching on a couple. The first on the left would be the great energy transition. So, I think all of us would acknowledge that the direction of travel here is pretty clear. So the move away from fossil fuels will happen. But the big question is when that will happen, and which industries are likely to see and be involved to see the most change, and at what cadence. So we've been doing a lot of thinking around the opportunities within the great energy transition sphere. And when you look at the portfolio today, we have companies here that are going to play their part in that transition, really right across the value chain. So we have some miners in the portfolio in BHP and Rio Tinto, who mine and provide commodities which are central to the building out of infrastructure needed for the transition. So materials like iron ore, like copper, are going to be central to the building out and the growth of electrification, for example, and the building of wind farms and the like. And so it's centrally important that we recognize where demand is going to come from that could influence those businesses. We also have semiconductor businesses, which are central to the electrification of everything. So, for example, the proportion of semiconductors in cars these days is 5 to 10-fold increase even just over the last year or two. So Tesla and Li Auto, which is another electric vehicle manufacturer we hold in the portfolio, a big part of what they need to do is optimize and build in semiconductors, which help the electrification and automated elements of the vehicle. And then finally, actually the renewable energies themselves. So we've begun to look at what facilitators there may be in terms of pure energy businesses, that may be long-term contributors to the great energy transition. But that also includes companies like Nexans, which we recently purchased, which effectively connects offshore wind farms with the on-land grid. So they specialize in subsea cabling. So another great example of a business which will be central to the transition, but you wouldn't necessarily think of them from the outset. So there's lots of opportunity in structural areas like these, which we continue to consider and we're excited about. And the other I was going to touch on was biology as a service, which is effectively another way of saying healthcare. And healthcare is a hugely inefficient sector. It's very capital intensive, and it takes a long time in many cases to bring drugs or treatments to the market. But we think that there are significant changes happening in the healthcare sector, which could be very lucrative for businesses. You will have heard of Moderna already, of course, with the COVID vaccine. But looking beyond the COVID vaccine, Moderna's developed a really strong treatment platform, which effectively has allowed them to roll out the vaccine. But they think that they can apply that treatment to a wider range of diseases and illnesses. As well as roll up the COVID vaccine in with the flu vaccine and treatments for RSV and other bronchital related challenges and diseases. So there's a big market for Moderna to attack and to roll into, but they've created the platform to do that, and they have a significant cash pile to fund that opportunity. But elsewhere, we also have a company in the portfolio called Certara, which specializes in biosimulation software. So what that effectively does is mimic the impact or effect of drugs on vital organs. And that effectively speeds up the trial process for drug developers and allows them to get products to market more quickly. So to my point earlier, addressing some of the inefficiencies in the healthcare sector. So these are really structural areas of growth that are really important to continue to focus on. So what we're not saying is that the current challenges that we see in the market around rising levels of inflation and interest rates, debt levels in markets around the world, we're not saying those are unimportant. They're absolutely important, and we're thinking hard about those. But it's also important that we think about the very long-term structural growth areas, and that we remain invested in companies that are likely to be either the drivers of that change or simply the beneficiaries. So there's lots out there to be excited about, and the nature of what we do in Monks means that we can really embrace that in a very diversified way, which leaves us very optimistic and excited about the future. So I'm going to end there, and I'd be delighted to take any questions from anybody, and it'll be a nice break from my dulcet tones.
Thanks so much for your presentation, John. So as John said, ladies and gentlemen, we're now going to head into Q&A. We've got a good bit of time for that, so please do type in any questions that you have for John now. I just wanted to start off by asking, given that volatility offers stock pickers opportunities, where are you actually seeing opportunities in the markets at the moment? Yeah.
So I think that's a nice question. So I've addressed the kind of longer term, or some of the longer term structural opportunities that we see. But I think what we're seeing is opportunities, I would say, in three main areas at the moment. First is where valuations have come back significantly, and that's effectively brought a number of, if you like, long admired companies back into our purview. So we've kind of seen businesses like Adobe, which we invested in earlier this year in April, like Analog Devices that I've talked about today. These are companies that we've liked for many years, but just haven't been able to invest in on valuation grounds. So we've been able to get into some positions that we've wanted to for a long time. So that's been very good from a long-term perspective. Related to that, we've also been able to add to existing positions in the portfolio that we think have been overly punished in share price terms. So I'm thinking here about the likes of Farfetch and Coupang. So Farfetch is a global online luxury goods platform, and it's just purchased a significant stake in its main competitor, which we think is a really strong sign for its competitive advantage. And we've added on the basis that has increased the probability, in our view, that this company goes on to become the absolute leading player in luxury goods. We've also added to Coupang, which is a South Korean e-commerce business. Again, it's investing heavily for future growth, which means it's unpopular with the market at the moment. But we think that's entrenching its competitive position relative to its peers. So that's the first area, is that valuations have come back towards us significantly. The second area would be where companies have significant cash ready to deploy at what we see as an advantageous point in the cycle. So, for example, we purchased a company called Royalty Pharma, which funds late-stage drug trials by collecting royalties from existing drugs that are already on the market. So it has a significant pile of cash to deploy into exciting opportunities. And given that the interest rates have increased, given that capital therefore has not only become more expensive but scarcer, we think those companies that have capital to deploy will now trade on a premium and are likely to be highly valued in different sectors across the world. So we're looking for opportunities actively where companies have capital to deploy at what we see as an advantageous point in the cycle. And then I think thirdly and finally relates to cyclical opportunities. Now, we think whilst share prices have been very volatile and been really, particularly in the first half of the year, have moved in a very much a downward trajectory, we do think that it's possible that there's still some pain left to come with regards to corporate and enterprise results. So we've seen some softening in earnings projections for businesses, but we think that could be worse. So the cyclical opportunities that we see, we've been doing a lot of groundwork on, particularly in housing-related cyclicals. For example, we've looked at companies that manufacture composite decking, that maintain swimming pools in the US, but also in the semiconductor sector, which is a naturally cyclical sector, but is becoming increasingly important given a proliferating number of end markets that semiconductors are used for. So we think there are some exciting opportunities there too. So 3 areas: one, where valuations are coming back towards us; 2, where companies have significant cash ready to deploy; and 3, companies where there's a significant cyclical element to what they do, and where the valuation of those businesses is very attractive.
Thanks so much, John. Now, one of our listeners here says that the remit for Monks feels similar to unit trusts like Global Discovery, and they've asked how much crossover investment ideas and research is there, and how different would the portfolios be in each fund?
Thanks. So the remit, so it's best to start with where they may be similar, and they may be similar in the way that we're investing in growth businesses. So absolutely, Global Discovery is managed by Douglas Brody, who's another partner at Baillie Gifford, but the remit of Global Discovery is very much more small cap. So Monks invests in predominantly mid to large cap businesses. It does have a small quota of unlisteds, and it does have a small proportion of less liquid or smaller companies that it holds. But by and large, it's a large listed collection of equities. Whereas Global Discovery is much more about investing in the embryonic early stage growth businesses that are highly innovative. And I think the crossover and overlap with Monks comes in the rapid growth part of the portfolio. As a proportion of the portfolio, you're talking something like 10% of the portfolio, perhaps slightly less. But the overlap certainly comes within that rapid growth part of the portfolio.
Thanks for that, John. A good one that we've got here: given the current economic climate and the gloomier predictions for next year, how would you argue that there is still a case for growth stocks right now?
Yeah, thanks. I mean that's a question that we rightfully get quite a lot at the moment, and I think that this is all about time frames. I want to say that it's been a jarring time for shareholders of Monks, and the share price and the NAV are down sharply this year, and a vast majority of that has been as a result of the change in sentiment towards growth stocks. Now we have taken time to analyze what we may have done better, and there's certainly lessons that we've learned. And if we had our time again, we perhaps would have made further reductions to a number of holdings within the portfolio that had done very well in the lead up to this. But the important point here is about timeframes. And for the vast majority of this portfolio, I think we're looking at growth companies where the foundations are very strong. So the balance sheets of the Monks portfolio is in aggregate very strong. So we've roughly a fifth of the level of debt that the broader market has. The margins on the portfolio in terms of operating margins and gross margins are significantly more attractive, which allows and affords the business's pricing power, but also greater flexibility in challenging times. And all this is important to allow businesses to navigate through a difficult period, but on a long-term view, so I'm talking 5 to 10 years, we think that the structural growth, some of the elements of which I've talked about with regards to the energy transition and the healthcare sector as examples, we think is important that we stay and remain invested where there is significant change, because that will underpin the earnings growth again, which will then deliver the share price appreciation and outperformance for Monks. At the moment, the market is not appreciating that in any way, shape, or form. But in a long-term view, we're confident that will come again, and that the portfolio will be able to deliver the outperformance that it was doing just 12 months ago.
Talking of difficult periods, I know you mentioned near the start that it's not possible to make predictions, but I'd be interested to hear how you're planning around the mostly somber inflation and interest rate expectations for next year. Yeah.
So, I mean, I think that would go back to the work that we've done within Monks, really February, March, and April, where we revisited work that we do periodically on inflation and interest rates. And it's not to say that we particularly have a strong view about where or when that might turn. But rather to say, well, let's put in place a scenario where inflation and rates are higher for a persistent period of time, more like 2 to 3 years. And what would that do to the portfolio? And what we did was analyze each holding within the portfolio against a range of different measures, including things like the degree of pricing power the business has, the capital intensity of the business, the speed of the business cycle, for example. And by looking at all of those factors, we then gave each of the businesses within the portfolio a rating. Was this company going to be a beneficiary of rising rates and inflation, or was it going to suffer? And actually, the overriding view was that by and large, the portfolio was pretty well placed, pretty flexible, and pretty resilient in the face of a period of rising inflation and rates, which is, gives us a lot of confidence about the existing portfolio as it is. Now, there were holdings and there are holdings that are likely to find things more challenging. So for example, we sold a company called Carvana, which is an online used car retailer. That was off the back of the work that we did, because we just felt that that business wasn't well positioned in the environment that we find ourselves today. And there are some businesses that we continue to review, but the important point and the key message is that a vast majority of the portfolio should be pretty well placed because of, for example, pricing power, or a very strong balance sheet, or a lack of a reliance on debt to navigate the existing environment. And actually, we can focus more on where the opportunities may be to pick up companies and add holdings to the portfolio that can really add and deliver returns for shareholders.
Thanks so much, Sean. Just to wrap things up for the Q&A part of today, I'd like to ask you to please just share your key takeaways from today's event, from your chat today, and a couple of main words of wisdom for our listeners.
So I think the main thing is that for Monks, and the takeaways I would say would be that firstly to recognise and understand in an empathetic sense that it's bruising to be involved in equity markets in the last 8 to 10 months in particular. But it's really important that shareholders and investors hold mugs to account. Our process is to invest in growth companies for the long term. So if we were to start to churn the portfolio significantly, to invest in areas that we have not been investing before, and to be selling out of large swathes of the portfolio, then they should rightly ask us why we're doing that and how we hope to add value in the long term. The crux and the basis of our approach has always been to invest in companies that can deliver above average earnings growth. The portfolio is doing that today, and we continue to monitor that on a very long-term view. And actually, we think that now is very much the best time to be a bottom-up stock picker. The market, in our view, is highly inefficient. There are companies that are significantly mispriced relative to their long-term growth potential. And now is the time that we in Monks are looking to take advantage of that. And with that approach and being patient, we believe that we should be able to deliver really very attractive long-term returns for savers. And that's what should underpin their confidence in remaining invested within the trust.
Fantastic. Thanks for that, John. So that is about all that we have time for today. So thank you for your questions. And thank you again to John for joining me. On that note, if your question didn't get answered, John and Baillie Gifford will do their best to do so after the event. Now, just before we close up, I just want to assure you again that your CPD will be delivered tomorrow, but also that we need your full name to be on display on your screen for us to get this to you and also to enter you into our prize draw. So if your username is not your full name, please could I ask you to type that into the chat now so that we have a record. Just before we close, let me leave you with a little teaser of what's to come from PA events over the next couple of months. Next Tuesday, the 13th of December, we'll wrap up this year with a working lunch with Schroders as they reveal the results of their latest financial advisor survey, which can assist advisors with their 2023 business plans. We'll be joined by Schroders' Gillian Hepburn and Alex Funk, as well as Philip Martin from Unique Financial Planning. After the Christmas break, we're quickly back in action with our first working lunch of the year on the 18th of January, where we'll be partnering with Baillie Gifford once again. The details of that lunch are going to be communicated to you in the next few days, so do keep an eye out for that. For those of you who would like to shake speakers by the hand at live events, our first roadshow of the year will kick off in Harrogate on the 24th of January, where multi-asset and MPS strategies will be on the menu. You'll hear presentations from Orbis, HSBC Asset Management, Morningstar, and 3 others, which will be announced shortly. After Harrogate, we'll be in Warrington on the 25th of January, Birmingham on the 26th, and then the following week, we'll be in Bristol on February 1st, and our final date is London on the 2nd. Details of all our events and how to register for them can now be found on the Professional Advisor website, so do visit there. That's it for today's session. All that remains is for me to thank John once more for his presentation, and of course our biggest thanks goes to you, our readers, for your company over this lunchtime. I trust you found this session helpful and worthwhile. If you did, perhaps we'll see you again for our final lunch of 2022 next week. Goodbye.